Filing your taxes is always daunting, especially when there are chances that the IRS could audit your return. These worries are valid, considering the 2022 Inflation Reduction Act that gave the IRS $80 billion in additional funds to tighten enforcement activities, among other things. However, in recent years, the IRS has audited less than 1% of all individual tax returns. Taxpayers also won't face enforcement effects from the additional IRS funding for at least another year or so, because it takes the IRS some time to hire qualified examiners and train them to audit complex tax returns. But this doesn't mean you can get away with not following the rules. Kiplinger, a personal finance resource, stated that one's chances at the unenviable audit lottery sometimes escalate based on factors such as the amount of income you report, the complexity of your return, the types and amounts of deductions or other tax breaks you claim, whether you're engaged in a business, or whether you own foreign assets. Kiplinger shared audit red flags to avoid if you don't want to draw unnecessary attention from the IRS. Things to not do if you want to avoid an audit. 1. Not reporting all taxable income. The IRS receives copies of all the 1099s and W-2s you have, so be sure you report all required income on your return. A mismatch sends up a red flag and causes the IRS computers to spit out a bill that the IRS will mail to you, Kiplinger stated. Also, make sure to report all income sources on your 1040 return, whether or not you receive a form such as a 1099. 2. Taking higher than average deductions, losses, or credits. If the deductions, losses, or credits on your return are disproportionately large compared with your income, the IRS may want to take a second look at your return, the personal finance website noted. The answer to this is keeping proper documentation for your deduction, loss, or credit.